At some point, someone told you to invest. A friend, a podcast, an article, maybe your own instinct after one too many months of watching your money sit still. But nobody told you what to actually buy. And that gap between knowing you should invest and knowing what to do is exactly where most beginners get stuck for years. Today, that gap closes. By the end of this video, you will understand what an index fund is, how it works, why it beats most professional investors over time, and what to look for when you're ready to start. No jargon, no charts you need a finance degree to read. Just the clearest explanation you will find anywhere. Quick note before we start. This video is for educational purposes only and is not personalized financial advice. Before index funds make sense, you need to understand what a stock is, and it takes about 30 seconds. When a company wants to raise money to grow, it can sell small pieces of itself to the public. Each piece is called a share. When you buy a share, you own a tiny fraction of that company. If the company grows and becomes more valuable, your share becomes more valuable too. If it struggles, your share loses value. That is it. A stock is ownership. A small, fractional slice of a real business. Now here's where most beginners go wrong. The natural instinct when you start investing is to pick the companies you think will do well. Apple looks strong. That tech company is everywhere. That energy firm seems cheap. The problem is that you are not the only person looking at those companies. You are competing against professional fund managers who do this full time, with entire research teams, access to data you will never see, and decades of experience. And here is the number that stops most people cold. According to S&P Global's SPIVA report, over a 15-year period, roughly 90% of actively managed funds underperform a simple market index. Not 10%, not 30%, 90%. If professionals with every possible advantage cannot consistently beat the market, the odds of you doing it from your laptop on a Sunday afternoon are not encouraging. So what do you do instead? An index fund is a single investment that buys a small piece of many companies at once. Instead of picking one company and betting everything on it, you are spreading your money across hundreds or even thousands of companies in one move. Think of it this way. Imagine a basket. Instead of picking one fruit and hoping it is the best fruit in the market, the basket holds a little bit of every fruit available. Some will do well, some will do badly. But the basket as a whole tends to grow over time because it tracks the overall health of the market, not the fate of any single company. The most well-known example of this is an index that tracks the 500 largest companies in a particular market. When those companies collectively grow, your investment grows with them. When they fall, your investment falls too. But over long periods of time, decades, not months, the overall direction has historically been upward. And the reason index funds work so well comes down to one thing most people overlook. Active fund managers charge fees to pick stocks on your behalf. Those fees are typically between 1% and 2% per year. That does not sound like much, but compounded over 20 or 30 years, a 1% annual fee can cost you tens of thousands of dollars in lost growth. Index funds, by contrast, simply track the market. No one is being paid to make decisions. The fund just follows the index automatically. That means the fees are a fraction of what active funds charge, often as low as 0.03 to 0.20% per year. Lower fees, broader exposure, less risk tied to any single company. And historically, better performance than most actively managed funds over the long run. That combination is why index funds have become the starting point of choice for millions of investors around the world. When your index fund grows and that growth earns its own growth, you get compound returns. A $1,000 investment growing at 7% per year, a conservative long-term estimate for a broad market index, becomes roughly $2,000 in 10 years without you adding another cent. In 20 years, it becomes nearly $4,000. In 30 years, it becomes over $7,000 from $1,000 left alone in a low-cost index fund. Now imagine adding to it consistently every month. This is why the single most important decision is not which fund to pick. It is when you start. Every year you wait is a year of compounding you cannot get back. You do not need a lot of money to start. Most platforms allow you to begin with very small amounts. When you're looking for an index fund, there are 3 things worth checking. First, the expense ratio. This is the annual fee. The lower, the better. Look for anything under 0.20%. Second, what the fund tracks. Make sure it follows a broad market index, not a narrow sector or theme. Third, the platform. Use a regulated broker or investment platform in your country. Check that it is authorized by your local financial regulator before putting any money in. You do not need to understand every detail before you start. You need to understand enough to make a sensible first decision and let time do the rest. So here is the simple version. A stock is ownership in a company. Picking individual stocks is a game most professionals cannot win. An index fund spreads your money across hundreds of companies automatically, charges low fees, and historically outperforms most actively managed funds over time. Compound growth does the heavy lifting, but only if you give it enough time. This week, one action. Find out what investment platforms are available and regulated in your country. Just look, you do not need to open an account yet. Just know where the door is.